OCC greenlights crypto activities for banks. The nation's banking regulator has opened the way for banks to offer crypto services. Now it's up to the institutions to show they can be trusted, say attorneys from Venable LLP. In recent months, the Federal Office of the Comptroller of the Currency, OCC, has signaled a more permissible regulatory stance towards national banks and federal savings associations, collectively, banks, engaging in crypto asset activities. I will continue to work diligently to ensure regulations are effective and not excessive, while maintaining a strong federal banking system, said Acting Comptroller of the Currency Rodney E. Hood earlier this year. On March 7, the OCC began formalizing its shift away from its Biden-era approach to regulating banks' crypto asset activities with the issuance of Interpretive Letter 1183. Through this interpretive letter, the OCC rescinded its supervisory non-objection process for banks seeking to engage in crypto asset activities, thereby removing significant red tape around banks' abilities to do so. This interpretive letter also reaffirmed the OCC's prior guidance permitting banks to engage in a range of crypto asset activities. The OCC followed up on this action in May with Interpretive Letter 1184. In it, the OCC further confirmed that banks may engage in certain crypto asset activities and addressed the roles third-party service providers, such as fintech companies, can play in those activities. The interpretive letter was generally supportive of third parties' involvement in them. The OCC's recent interpretive letters signal a shift away from the more cautious and restrictive approach taken by the agency under the Biden administration and the OCC's confidence in banks' abilities to manage risks associated with crypto asset activities. They reaffirm that banks are permitted to engage in certain crypto asset activities and expressly permit third-party service operators to provide crypto asset custody services, to be sub-custodians. They also give banks a green light to explore crypto asset opportunities, as such opportunities may arise by eliminating the supervisory non-objection process first adopted in 2021. Previously, a bank's ability to engage in crypto asset activities was constrained by a supervisory non-objection process adopted in 2021 that required banks to obtain the OCC's tacit approval before engaging in such activities. The OCC's recent interpretive letters eliminated this supervisory non-objection process. In its recent interpretive letters, the OCC reaffirmed that these crypto asset activities are still permissible banking activities. The OCC also expressly confirmed that banks may use third-party, which indicates that the OCC might also be supportive of third-party service providers participating in banks' other crypto asset activities as well. Under the now rescinded Interpretive Letter 1179, banks seeking to engage in crypto asset activities were required to notify their OCC supervisory office and obtain a written non-objection before proceeding. Non-objection letters would be issued only if the bank could demonstrate, to the supervisory office's satisfaction, that it had adequate risk management processes in place to identify, measure, monitor, and control potential risks associated with its planned crypto asset activities. Additionally, banks had to show a clear understanding of the laws applicable to its planned crypto asset activities, such as federal securities laws, anti-money laundering laws, and consumer protection laws. Eliminating the supervisory non-objection process removes a significant regulatory barrier to banks' abilities to engage in crypto asset activities. However, its removal does not absolve banks of their responsibility to effectively manage the risks associated with these activities. Moving forward, these activities will be reviewed by the OCC as part of its regular supervisory process. That means banks engaging in crypto asset activities must still ensure that such activities are carried out in a safe, sound, and fair manner, and in compliance with applicable law. If a third-party service provider, such as a fintech company, will be involved in them, banks will be expected to implement appropriate third-party risk management practices as well. By eliminating the supervisory non-objection barrier, the OCC has placed greater responsibility on banks to implement the appropriate comprehensive risk management frameworks. They may find it easier to integrate crypto-related products and services into their offerings as a result. Still, the OCC will likely expect banks to implement strong controls to manage the risks associated with these activities, consistent with those outlined in the OCC's previous interpretive letters and guidance. For example, banks engaging in crypto asset activities should align with these expectations. However, crypto asset activities remain relatively novel in comparison to traditional banking activities, and the compliance questions they raise may not yet be fully understood. The OCC's safety and soundness expectations may evolve, and new legislation may alter applicable laws. Staying up to date on the regulatory landscape surrounding crypto asset activities is likely key for banks engaged in them. Banks engaged in crypto asset activities may be able to stay ahead of new regulatory developments by taking a proactive approach to managing these risks, such as by developing robust governance frameworks to prevent regulatory gaps and engaging with regulators and industry to inform supervisory expectations. Andrew Bigart focuses his practice on helping bank and non-bank financial institutions navigate the federal and state regulatory environment governing payments, lending, and consumer financial services. Andrew provides regulatory and business counseling advice to clients across a variety of industries, including banks, payments companies, money transmitters, broker-dealers, lenders, and trade associations. He counsels clients on regulatory compliance matters, contract negotiations, due diligence, federal and state examinations, and civil investigations and litigation before federal and state banking and financial institution regulators. Andrew has been recognized by Legal 500 and named to the Electronic Transactions Association's 40 Under 40 list. Chris Boone focuses his practice on regulatory issues related to payment processing, blockchain, advertising and marketing, transportation, and telecommunications. Chris provides counsel on regulatory compliance, contract negotiations, and general business matters. He also regularly assists clients in responding to federal and state investigative inquiries, demands, and complaints from the Federal Trade Commission, FTC, the Federal Communications Commission, FCC, state attorneys general, and other federal and state authorities. Connor Webb provides regulatory advice and counseling to banking and financial services businesses to help them meet their objectives. Connor works with banks, payment companies, money transmitters, lenders, fintechs, and consumer financial services companies to help them navigate the federal and state regulatory environments in which they operate. He provides counsel on regulatory compliance matters, contract negotiations, state licensing requirements, economic sanctions compliance, advertising and marketing issues, due diligence, and federal and state examinations and investigations. Connor regularly advises businesses on complying with Consumer Financial Protection Bureau, CFPB, Federal Trade Commission, FTC, and payment network requirements.